Hey everyone, and welcome to This Explainer. Today we are taking a completely objective, deep dive look at an iconic American tech giant that is standing at a massive crossroads right now. We're going to break down the hard data, the market realities, and the future roadmap for Intel just to see exactly what is going on beneath the surface. $20. That's it. Right now, Intel is trading at roughly $20 a share. Now, to put that into perspective for you, these are price levels we haven't seen since the depths of the 2008 financial crisis. And the crazy thing is, this is happening despite the CEO making huge personal stock purchases and the company receiving massive financial backing from the government. So that brings us to the literal million-dollar question of this entire explainer. Is Intel stock a deep value, like a historic buying opportunity just waiting to rebound? Or is it a value trap, a stock that looks cheap on the surface but is actually on a long, slow path downward? We're going to comprehensively look at both the massive upside and the severe risks here, so you can understand exactly what's at stake. Here's how we're going to break it all down today. First, the current situation, then the bull case, followed by the bear case. After that, key catalysts to watch, and finally, strategy and final verdict. All right, let's jump right into part one. The current situation, the setup. Let's look at the numbers. With the price sitting right around $20 to $21, Intel's total market cap has compressed to roughly $90 billion. Now you'll notice the PE ratio is currently sitting around 30, but keep in mind the forward PE is actually lower because the market is pricing in an expected earnings recovery down the line. They're offering a pretty juicy 5.2% dividend yield right now, and that 52-week range, it sits from $19.50 all the way up to $46. So the stock is sitting right at the absolute rock bottom of its yearly range. And well, to understand why it's at the absolute bottom, we really need to look at a recent announcement, a $20 billion share sale. Now look, selling shares dilutes the value of existing shares, which, as you probably know, investors generally do not like. But the crucial point here is why they did it. This cash is literally a lifeline. Intel is a company in massive transition, and they're using these funds to aggressively build out their foundry business, essentially their physical chip manufacturing factories, all in a bid to catch up with their main rivals, TSMC and Samsung. Okay, so that's the setup. Let's move on to part two, the bull case. Why exactly would you buy this? We can really boil the bull case down to three main pillars: deep value metrics, insider confidence, and a massive geopolitical tailwind. Let's unpack each one of these to see why some investors are getting incredibly excited about this setup. First up, those deep value metrics. On paper, this stock looks ridiculously cheap relative to its own history. The price-to-book ratio is sitting at roughly 1.2. What that means is you're essentially paying just a microscopic premium over the literal liquidation value of the company's physical assets. I mean, think about that for a massive tech giant. In fact, based on asset value alone, some analysts actually peg the stock as being 81% undervalued right now. If you're a value investor, this is exactly the kind of massive discount metric that makes you sit up and pay attention. Second, we have insider confidence. CEO Pat Gelsinger, along with two other top executives, recently went out and bought millions of dollars in open market stock purchases. And look, this isn't just performative PR. They aren't just being granted free stock options. They're taking their own hard-earned cash and putting it on the line at these price levels. When leadership buys the dip with their own money, it usually signals a very genuine belief in the turnaround. Third, there is a massive geopolitical tailwind at play here. Intel is the primary beneficiary of the U.S. government's CHIPS Act, receiving over $8.5 billion in grants, plus access to additional loans. Objectively speaking, the U.S. government desperately wants domestic chip production for national security and supply chain resilience. And right now, Intel is the main American company capable of delivering that domestic production at scale. They essentially have the financial backing of the U.S. government to ensure they do not fail. And all of this money, all of this effort, builds to their ultimate goal. If their highly anticipated 18A node, which is basically their next-generation chip manufacturing technology, hits its production targets between 2026 and 2027, it could allow Intel to actually retake process leadership in the entire semiconductor industry. If they successfully pull this off, we are talking about a multi-billion-dollar swing in revenue and a total absolute shift in market sentiment. But of course, there's always another side to the story. Let's move to part three, the bear case, or why you might want to avoid this completely. Just as there are three pillars to the bull case, there are three critical risks threatening this whole recovery: cash burn, fierce competition, and a really long turnaround timeline. Let's break these down, because believe me, these risks are very, very real. Risk number one is an absolutely alarming cash burn. Building massive, state-of-the-art semiconductor foundries is insanely expensive. Right now, Intel is spending roughly $25 billion a year on capital expenditures, and they're doing this while their overall revenue is actually shrinking. Because of this, their free cash flow is negative, meaning they are burning through their cash reserves at a rapid pace. Remember that $20 billion share sale we talked about earlier? That wasn't just from clever strategic move. It was a desperately needed lifeline just to keep the lights on for this transition. The second massive risk is the competition, and it is fierce. AMD has ruthlessly eaten into Intel's former dominance, now commanding about 35% of the highly lucrative server CPU market. Meanwhile, over in the artificial intelligence space, Nvidia is absolutely dominating, boasting gross margins of 80% or more. Intel's own AI accelerators are currently sitting as a very distant third in that race. Basically, they are fighting a war on two fronts against incredibly nimble and successful competitors. And the third risk? The timeline. Look, this is not a quick fix. Intel has openly stated that their foundry business won't even be profitable until at least 2027. That means investors have to stomach 2 to 3 more years of heavy financial pressure on the stock. And worse, because of that massive cash burn, there is a very real possibility of a dividend cut. If Intel cuts that 5.2% dividend, income investors are going to head for the exits, and it could easily drag the stock price down to the $15 to $17 range. Which brings us to part 4, key catalysts to watch. Here is the roadmap for how this actually plays out. If you're following this company, here's your chronological roadmap. Over the next 12 months, keep your eyes peeled for the dividend announcement. If they cut it, it signals panic and cash preservation. But if they maintain it, it signals confidence. Next, in Q4 of 2026, we're going to get the yield data on that crucial 18A node. Yield, which just means the percentage of actual working chips they can produce on a silicon wafer, is the ultimate make-or-break moment. If yields are solid, the stock could double. If they fail, the stock could get cut in half. Finally, looking out to 2027, we watch for the inflection point where all this spending peaks and they finally become free cash flow positive. All right, let's wrap this up with part 5, strategy and final verdict. For those of you actively watching the charts, here are the technical levels derived from the source material. The immediate floor or support is right around $19.50. Now, if that breaks, maybe due to a dividend cut or some bad news on the foundry side, the downside risk takes us to that $15 to $17 range. On the way up, resistance sits at $24, which aligns with the 50-day moving average. But if execution improves and they actually hit those 18A targets, the long-term upside target sits between $35 and $40 by 2027. So how should you actually approach this? Well, the source analysis clearly splits the verdict based on what kind of investor you are. On one hand, if you're a long-term investor with a lot of patience, accumulating below $22 might make a lot of sense given the compelling upside. However, because this is a high-risk turnaround, it really warrants no more than a 2 to 5% portfolio allocation, and you absolutely need a 3 to 5 year time horizon. On the other hand, if you're a short-term trader or an investor who absolutely relies on safe dividend income, the verdict is to stay away entirely. There's just way too much volatility and way too much dividend risk right now. Ultimately, Intel right now is a highly speculative turnaround, not a safe core holding. But, with the stock sitting exactly where it is, the risk-reward ratio is undeniably fascinating. So I'll leave you with this final thought to apply to your own financial decision-making. At $20 a share, with billions in government backing but an absolutely staggering cash burn, is Intel a historic buying opportunity, or is it a falling knife? Thank you so much for joining me for this explainer, and as always, keep learning.